Good morning and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Tuesday, March 3rd, 2020. I don't know about everybody else, but I'm glad February is over. That last week of February, not a good one. But we did rally to start March, so we'll see what happens, see if we can follow through today. But it certainly has been a wild roller coaster ride here over the last couple of days. Taking a look at some of the things that we're going to get into today. Of course, I want to go through that market recap with you yesterday. It was a big day on Wall Street. Got a lot of gains back. Still got a lot to go. But at least was a nice relief day for those who had been holding through a lot of what we saw in the week prior. I'm going to get into talking technically. And what I thought we would do here today is I want to go back through over the last, 10, 12 years, some of the bigger scares and what the S&P 500 did, what the Volatility Index did, and try to look at how the reaction took place. I mean, nothing is going to guarantee us what's going to happen this time, but it is important, I think, to go through and take a look at history. I mean, I've talked a lot recently about the fact when you get a volatility index up at the 50 level, you're either at or really close to a bottom. The only time since we've been tracking the VIX, the only time we've seen a significant move above 50 was when we had the near financial system meltdown back in 2008. So it's a pretty good indicator that when the fear level just gets to a point, that's just telling you the market is so irrational that everything's being sold, doesn't matter. We're getting out, everything, the market's going to collapse. And that's usually when the bottom goes in. But again, we want to take a look at what happens after that. So that's what we're going to do today in talking technically. Earnings spotlight, got a few earnings reports we can talk about. Honestly, I'm not sure how much the market's even looking at earnings right now because it's so cloudy going forward with everyone trying to figure out, what the economic impact is going to be from the coronavirus that I'm not sure. There might be an initial reaction to earnings, but I'm not really sure in the short term that's what's going to be driving the market. Upgrades, downgrades, got a few of those we'll take a look at. And then we will end the show with three you must see. So those are three charts that I think it's worth taking a look at as we get ready to open another trading day. All right, so let's get into that market recap and let's just talk about what the heck happened yesterday. Big rally. Dow Jones Industrial Average up almost 1,300 points. I don't know about everybody else. I don't like these big swings back and forth. It makes it really hard emotionally, especially as a short-term trader. If you're long-term, and what I've been saying to members at Earnings Beats is don't blink. I mean, this is why you're long-term. You're looking past these wild moves. You're looking at the long-term, meaning, many years out. And these things just in the rearview mirror don't look like a whole lot. In the day, in the moment, they're pretty difficult, the swings back and forth and the emotions and everything else. But long term, you shouldn't be worried about these short term high periods of volatility where the market sells off. Just stay the course. Don't worry about it. Then there are traders like me and some of you, I guess, watching the show. And this is crazy. I mean, if you can nail all these directional moves correctly, you can make a fortune. But if you don't hit them correctly, and your emotions start getting the best of you, you start making all the wrong decisions at all the wrong times, and they're very painful and expensive. So my philosophy, for the most part, unless I find something that's really I feel like my potential reward is so great compared to my risk that I'm willing to take a chance, and even then, probably with a small portion of my trading funds, then I might get into the market for a period of time, short period of time. But I think you have to be really careful in the near term because you don't know what you're going to wake up to. This isn't just big moves intraday. These are big moves from close to the next day's open. And so if you're on the wrong side of the trade and holding overnight, that can be really brutal too. But the Dow finished up 5% yesterday, up 1,300 points. The S&P 500 up 4.6%. Back above 3,000. One of the key levels I was watching was 3,025. If you recall, that's where we broke out from back in October. So we went back through 3,025 like it wasn't even there. And then we came right back up, paused a couple times during the day, but that rally into the end of the day was nice. to get back at least above that 3,025 level. NASDAQ, nice day as well, 4.5%. Mid caps 3.4, small caps 2.6. Even with the big rally, you can see that the relative performance of mid and small caps just cannot get going. It's been like this now for a couple of years. Usually, small caps and mid caps outperform the S&P. This is one of the longest stretches in history or recent history where small caps have underperformed the way they have. All right, looking at the groups, you can see the 5 top industry groups, and this is impressive and maybe a little cautious at the same time. Utilities, staples, real estate. 3 of the 4 defensive groups, if you want to throw healthcare in there. I mean, I think healthcare is kind of a little hybrid. But these are the 3 that I look at as the most defensive groups, and they were 3 of the 5 leaders yesterday on this move. So, yes, it felt good. But just like there was indiscriminate selling on the way down, for the most part, there was indiscriminate buying. It was just everybody, it was a relief rally. Everybody's jumping in. I would have preferred to see more of our aggressive groups on the top. Technology did make a big run into the close, though. I will say that. Technology, probably at 3:30 yesterday afternoon, was maybe middle of the pack. And by the time the market closed, it was second, trailing only utilities and not by much. So there was definitely some late buying that came into technology, which was good. But you can see off the big reversal, technology, the XLK was down at 84 at the open on Friday, closed yesterday at 93. That's over 10%. That's a good year. And essentially we did it in one trading day. It's crazy the way the volatility is in a market like this when we're really fearful. Staples also, big day, financials. Nice to see financials come back, especially with the 10-year Treasury yield still down at some really low levels. I think we're going to need to see that 10-year Treasury yield start to move a little bit higher to get financials going much higher. I was surprised, actually, that financials were on the top half of the leaderboard. And then we had real estate, a defensive group, after that nice hammer printed on Friday. Big reversal there. So XLRE looking better. But still, none of these groups, even though we had a big rally, they're still broken. We've got multiple levels still to try to get through, and we'll talk about some of that in just a bit. 10-year Treasury yield, let's get an update. This is a little bit of a stretch chart going back about a year. And you can see we are getting a little bit of a pop today in the Treasury yield. One thing that bothered me yesterday was that the yields were down. So anytime the yield's down for the day, it's telling me money's rotating into Treasuries. And while that's also, money's also rotating into equities, I would prefer to see money rotating out of Treasuries because it's more money to rotate into equities. So when the stock market goes up and the Treasury yields go down, that means Treasury prices are going higher. And that can sometimes signal more of a short-term advance for equities. I want to see money rotate. And what was happening when the stock market was going down, you can see the rotation was going the wrong way. It was coming out of the stock market. It was going into the Treasuries. So I'd like to see that reverse. This morning, nice little pop there. We'll see whether or not that carries over into some strength in the U.S. stock market. I will say right now, just to give you a quick update, I'm looking at the spider in pre-market. It's down about 1/3 of 1%. And the Qs, which tracks the NASDAQ 100, down about 1/5 of 1%, down 0.19% pre-market. So that gives you a little bit of an idea of what we're looking at as we approach the open today. Now, I'm going to walk you through some, back down through memory lane and through history in the market. This is a chart of the S&P 500, the VIX on the bottom. And the next several charts I show you are going to be like this, just different time periods. So here we are back at the end of 2008. Remember the financial crisis? The S&P 500 from late September up at about the 1,220 level. And by the 10th of October, it was down to about 840. Again, 1,220 to 840 in 10 days. That's about a third of, actually, I think it might have been just a little bit less than that, but roughly a third of the entire capitalization of the S&P 500 gone in, I don't know, maybe 10 trading days. Pretty scary stuff. Look at the VIX. VIX in this case went up initially to about 75, Look at the bounce we had on October 13th. That was a Monday. So here was the big drop over the weekend, came back on a Monday, big move up, went up a little bit on Tuesday, and then right back down. We were testing the lows pretty quickly. Now, this one stands out as probably the most volatile period of all in my mind, especially when you see the VIX hit 90. Never has done that before in history, not even close. So, and then after that, by the way, we ended up going lower. But again, the fear was so bad. Things, it was a really rough period. If you weren't trading back then or investing, I can promise you, it was a very scary period when you start seeing major financial institutions collapsing. That obviously impacts everything we do. And so that was probably the biggest scare that I've ever been associated with in the stock market. And as you know, history tells us I didn't keep going forward, but later in 2009, we actually went down one more time, down the 600s, and ended up, but that was a secular bear market. All the rest of the charts I show you now as we move forward are going to be secular bull markets. So let's move on. Now we're into the spring, summer of 2010. So we've come off of those lows. You can see the S&P 500s all the way back to 1220, back where we started that huge decline at the end of September, early October of 2008, back to 1220. And as we headed into May, it was probably about 7-8 trading days later, we were back down to about 1070, 1065. Pretty big drop. I mean, that we're talking about 150. That's probably about 13%, very similar to what we just had. Here, you can see the volatility index went up over 40. We closed on Friday at 40. And look at what we ended up doing. We went up for about 3 days, hit the 20-day moving average and rolled back over, came back down and retested. Volatility index went up one more time, got close to 50. Then we ended up putting in the bottom. Let's go keep moving. Now we move on to 2011. So that was 2010. This is 2011. Look at the drop we had back at the end of July, early August. Once again, and notice when the market gets fearful, when that VIX starts getting up into the 20s and especially into the 30s, this is why I always say I go on the sidelines. I like to sit in cash because this is how rapidly prices can deteriorate when the VIX gets up into these levels. So if you learn nothing else from history, just remember when that volatility index, and I'm not talking about when it goes from 12 to 14, I'm talking about when it goes from about 15 up to about 20, 22, 25. That's when things can really start to get tough. And that's where I want to protect my capital. But anyway, here you can see in August of 2011, VIX gets up to about 48. And that dropped from 1350 down to 1100. What is that? 250 points. That's almost 20%. Probably just a little bit under that. In maybe 12, 13 trading days. VIX up near 50, and then look what happens. Get a lot of volatility, move up, move back down, move back up. Struggle, though, to get through the 20-day. Come back down, double test, double bottom. Ended up going just a little bit lower back in October of 2011 before the move to the upside resumed. And at that low, you can see the volatility index at 46. But this whole period right here, the VIX never went back down below 30. That's a really crazy period to try to trade. I mean, if you can hit it perfectly and you know exactly when everything's going to turn in both directions, then you can make a fortune. But if you can't with the volatility index like this, you make a big move, you go up here. This doesn't look like much. This is a 10% move up in 3 days, 10% move right back down in 3 days. That is scary and very difficult to try to trade. Moving on. How about 2015? So this is August, September, October 2015. Remember when we were consolidating? Here's August. Look at this 5-day drop from 2100 down to 1870, almost 1860. So we're talking about 230 points. That's probably 11%. Very similar to what we just went through. Where'd the VIX top? 52, 53. All right. Ended up, look, big rally. Once we get that VIX up to 50, big rally, struggle to get back through the 20-day moving average. Here we did, but we couldn't really close above that prior high, and then back down, double bottom. Next up, 2016. So now this is when it looked like we were actually breaking down. This was actually one of the scariest times during this secular bull market for me, because we did break down. This breakdown here in January 2016 and the double bottom here in 2017 actually took out the prior lows in 2015. And a lot of other signals were telling us to be careful. But you can see the VIX. Where'd the VIX get to on this one? 32. Left a long tail to the top, left a long tail to the bottom, get back up to the 20-day moving average, a little bit above, right back down, double bottom. That's where we really started to take off from, on that double bottom. Next up, March, this is the end of 2018. So here we were at the high, 2017 into 2018. The VIX was down around 10, looked like we didn't have a care in the world. 7 days later, 8 days later, went from 28.75 all the way down to 25.30. 500 points, 540 points, just under 20% there. Big move down. VIX, where'd it top at? 50. Now, notice here we went to 50, but we did go down one more time, even though the VIX didn't go any lower, or excuse me, didn't go any higher. We did print one more low. But I think, again, when you start getting a VIX at 50, you are getting to a point where we're trying to carve out a major bottom. Next up, this is the end of 2018, Q4. So here's the big drop, but especially in December, you can see the huge drop just from here, 2,800, 2,350, 450 points, which is roughly 16% in about 3 weeks. VIX tops out here at 36. Now this one, we had a V bottom. If you were waiting to get back in at 2,350, it never came back. First thing you did is you went up through the 20 and you didn't come back down below it. That's one thing I would be watching. If we get right back up through the 20-day moving average now, that would be awesome. Here we are today. So here's our big drop. There's a reversal. Look where the VIX went to. Long tail to the top on the VIX, 50, and now we rebound. There's your 20-day test coming up, and here is where the gap and all the volume really started. So I'm going to say 32.20, 32.15, up to about 32.60. That's going to be a major test, I think, for the S&P 500 as we move higher. If we can't get through there and start to roll back over, and the coronavirus is still in the news and the headlines and the cases are multiplying, I think we have a pretty good chance coming back down to this 28.50 level. And I'm not sure we get all the way up there, by the way. I mean, maybe we just come right back down. What I am saying is that we still are sitting with a VIX at 33. Very difficult period to try to trade. So please, please, please be careful out there. All right, let's move on to earnings. And I want to pull up first. Let's go with Target. So Target came out. They did beat on their bottom line, $1.69 versus $1.66. A very slight move to the upside pre-market last time I looked. But the problem here with Target, you see the gap support at 110? We went back, we filled, we held, bounced, and then we came back through 110. Yesterday, we get up to 109.06. Today, we're seeing a fractional move to the upside. We've got two levels here on Target to get through, 110 and that 20-day moving average. Until it can get through both, I would be careful here. Broadline retail did hold on to its January low. And trust me, when I say this, there haven't been many industry groups that have held their January low. Broadline retail has been one of them. So this has been a stronger group. So if Target does make the move through these key resistance areas, that would be a good sign, I think, for the stock. AZO, AutoZone. They beat on their bottom line, $12.39 versus $11.87. Stock down 4.5% pre-market last time I looked. This is one, I think I had talked about this one with members probably back at the end of January as it got down to this key support level around 1050. Just saying that, hey, if it's going to bounce, this is it. It did bounce one more time, got up to the 20-day, failed, and right back down below, taking out this prior support level at 1050. Now we come right up to 1050, report earnings, and we're back down again. Don't like the way this one's shaping up. Look at the relative weakness versus specialty retail. Not great. And specialty retail hasn't been horrible versus the S&P, but you can see that it did put in a lower low from January. So a little different than the broadline retailers. Let's see. Next up, take a look at SE. The stock reported better than expected earnings, 53-cent loss versus 62-cent loss that was expected. Stock is up over 5% pre-market. That's going to take it up probably a couple bucks, maybe around the 50 level. I would expect maybe it just continues to consolidate here. It is in the computer services area, and it has been one of the best stocks. breaking out relative to the computer services group. But until we get a breakout, I would be treating this as sideways consolidation. Kohl's out with earnings this morning. 199 versus 188. That was their earnings per share. So they did beat. Stock up 4.5% pre-market. But this is one that has been a laggard in the apparel retailers. And you can see apparel retailers lost that January support, unlike broadline retail. So you got one of the worst performers in a group that's just been okay. It's up today. I have a feeling we're probably going to see a failure if it can get up to the 20-day moving average. So I would not be a fan of Kohl's unless it, obviously if it breaks out and has a character change on the chart, that would be a different story. But what I'm seeing right now, I would expect maybe a gap up and failure. One last earnings report from this morning. IGT, you can see the stock just absolutely getting crushed to the downside. This is in the gambling area. This is one of the areas that's been hit very hard by the coronavirus fears. You can see the gambling index way below the January low. And the last 10 days, it's been a very, very tough ride for the gambling stocks. And of course, IGT being part of it has been going down not only with it, but look at the relative weakness. It has been one of the laggards in a very weak group. I'm not interested in a stock like that. The stock did beat, bottom line, 31 versus 26 cents. Stock's up 14% in pre-market, which is probably going to bring it up here around the 11 and a half area. And that's about where we broke down from. This is a beaten down stock. Maybe it gets a little bit of love in the very near term. But unless the coronavirus fears go away completely, I just don't see this thing returning back to where it was. So I'd be a little careful after the gap up this morning. Let's see, another company reporting. This is a smaller company that was reporting after the bell yesterday, LVGO. This is Livongo Health. It is in the software space. The stock had really started to move back here in October and November, and then went sideways while software kept going higher. So it showed a little bit of relative strength and then kind of went sideways, maybe even underperformed a bit. They came out, they reported a profit of 2 cents. The market was expecting a loss of 6 cents, and the stock is up about 4.5% pre-market. So it looks like it's probably going to clear, or maybe it's going to be right at about the 28 level. Let's see, 4% would be $1.04. Yeah, maybe around $1.20. So that would be 27.90. Yeah, it really needs to get above this February high before I would start to see any interest. And I'd really be much more interested if we got that breakout above the January high. So it's got some more work to do. If it gaps up below the 28.25 level, my guess is maybe it just stays in this trading range, 24 to 28. But we'll see how it reacts after its earnings. All right, upgrades and downgrades. We'll talk about a couple of these, and then we'll get into the 3 you must see and wrap up the show. Advanced Micro Devices got upgraded today. Stock is up a couple percent pre-market. And I'm saying this, but this is as of 30 minutes ago. And the way the market moves, you want to double check me on this. Actually, one way we can look at it is, let me pull up, actually, I'll go over here. And let's pull up symbol summary. If you haven't used this, pretty cool new feature here at StockCharts. AMD, you can see, is currently up almost 3% pre-market. So nice movement there. And then over here on a relative basis, I actually like this. Semiconductors broke down below the January low, but on a relative basis, AMD continues to hold up. So this is one that if the market does do its thing, and this is a V bottom and we keep going higher, I expect AMD is going to be one of the leaders. This was one of the leaders going in. I think it's still leading. And so, yeah, I think that this upgrade's probably a good one. I think it just, again, comes down to what the overall market does, because the selling, I can't emphasize this enough, the selling last week was indiscriminate for the most part. Everything was being sold. When you get into a fearful market, it doesn't really matter that you have stocks with relative strength. They get hit too. Maybe their strength builds a little bit, but for the most part, they get hit just as well. Another upgrade was Pulte Homes. I was wondering if we would get some upgrades on these home builders. My gosh, the interest rates dropped. I mentioned on yesterday's show at Earnings Beats, I refinanced. I hope everyone's taking advantage of this. If you own a home, check out the mortgage rates. I bought in July of last year at 4 3/8, and I got in at 3 1/8 yesterday. So 1.25 point drop in just the last 6 months. But the 10-year Treasury yield has just obviously tumbled over the course of the last month, and that is why we're seeing the mortgage rates come down. So PHM, Pulte Home getting upgraded today, stock up about 1% in pre-market, or let's just see where it is now. So it is, just about 1% pre-market. So it's still, on this downtrend. It's got some moving averages, price resistance up near 44. It's going to need to clear, but it's held the lows that we saw back in November and December. So for me, down around 38 would be the key support area to watch. 47 is your resistance. I think Pulte is just consolidating, and if rates stay low and we come out of this, I expect home builders would do very well. Certainly, it's set up for them. Downgrades, how about Halliburton getting downgraded today? And the stock pretty flat with the downgrade. Stock has just been hammered. It is testing some key support. I don't know about a downgrade here just because it's at a technical support level. But if it gets back up to the 20-day moving average, the oil stocks just can't catch a break. They were underperforming in a good market, then the market gets fearful and they still underperform. They just literally can't catch a break. Last one here, Schlumberger getting downgraded, also relatively flat. Tried to reverse yesterday, big move into the close. Nice volume the last couple of days. Maybe we have a little bit more room. We broke down on Schlumberger just below $30. So if we can get a couple more bucks up to that level, you're going to see the 20-day dropping. That $30 might be tough to get through. But in the near term anyway, I think maybe we have a little bit more room to the upside. So I don't know about downgrading these stocks after they've taken such a huge hit. I would look for a little bit of a bounce here. All right, let's move on to the 3 you must see. And I'm going to start with I'm going to actually go in and look at industry groups here. Because individual stocks, like I said, everything's going down, everything's going up. It's really about fear. It's about what's driving the market, what's been struggling in the market. Well, you can see renewable energy broke down yesterday. So even though the market went up on a relative basis anyway, it went down. You can see the big breakdown below the prior low. So now we are trading at about a 10, 11 month relative low on renewable energy. And you can see on an absolute basis, we also broke down. So renewable energy is an area that has been getting hit. And it didn't look that bad just a few weeks ago. But all of a sudden, big drop here on renewable energy. Another group that is similar, I'm going to go back over here to my list. I'm going to pull up the airlines. And, some of these just make sense. Some of them don't make as much sense, selling off with the coronavirus. This one certainly makes sense. Airlines, they're having flights grounded. And the more areas around the world that things are breaking, where the coronavirus is breaking out, the more struggles that the airlines are having. So here is your relative strength, which has just fallen right off the table. Look at the absolute move to the downside. Now, when is enough enough? I mean, we are now down from 270 to 205 or 208. That's 62 points. That's 23% in just a couple of weeks, maybe 7 trading days. That is an awful lot. Lots being priced into this group right now to the downside. And then finally, I wanted to also mention the recreational services group. And another one. Now, this is going to include your cruise lines and things like that. Obviously, huge move to the downside on a relative basis, big breakdown. And then check out since the beginning of the year, just a movement from 152.50 to 102.50, a little over 50 points. So we're talking about 1/3 of the market cap of these recreational services companies gone in 2 months, less than 2 months. Pretty darn impressive to the downside. All right, that's it. Wishing everybody a great day today. Happy trading. Be back on Thursday.